And welcome into Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, founder at TJ Stearns Inc. We always appreciate you being here on Protect and Grow, Tim. Thank you for being the resource for proactive savers and investors, providing guidance and insight on our money, to how it works to help us achieve our important financial goals. And as always, we're wondering what's up in the world of Tim Stearns and of course the markets.
Well, I'll tell you what, we always have a thought of the day, and my thought of the day, especially with the way the market has been and that type of thing, is, no matter where you're at in your life, you need to be prepared for volatility in the market.
Yep. Yep. Tim, I actually went out over the weekend. I was with my son at a number of baseball games. We do travel, and he had a tournament, and it's inevitable. The first one of the year, I always catch a pretty bad sunburn. It's funny. Like I knew that could happen. I should be smart enough. I've seen it before. I should have been prepared.
Yep.
And yet the avoidable happened anyway because I did not prep correctly. Kind of the same thing when market volatility catches people on their toes, right? Or off their feet. We know it's an ever-present danger. We know it's going to happen eventually, and yet still so often we are unprepared when it does happen.
I think we get lax, especially when it comes to the markets. I mean, how many times do we have to get burnt back, years ago, and now we have markets that bounce right back, and we get, lackadaisical about them, and we think, oh, they're just bounced back. A lot of people who are in as advisors have never even seen a bull market turn into a bear market overnight, like you and I have, because we've got gray hair. Or at least I do, Peter.
I've got a few, Tim. I've got a few.
Right, but
you've seen it. You've seen it a few more times than I have, though.
Yes, sir. And that gives you pause, especially, if you're a baby boomer that's about to go into retirement, if you have a market that, challenges you where it goes down for a while, it's going to be a hard road, and it's going to set the tone for your retirement. And that's the last thing you need.
Yeah. And what happens, Tim? I mean, we've got this lump sum of money that's giving us confidence, right? $1 million, $2 million, $5 million, whatever the number is for people. We retire, and then 6 months later, the markets drop by 25, 30, 35% or more. They lose that confidence pretty quick, don't we?
Well, one thing we do know about baby boomers is they're great at saving for money, for retirement. They're great at that. They're really bad at spending it. And then you couple that with a down market, they are going to freak out and they won't know what to do. And with that comes so much stress, anxiety, you name it, and off to the races we go of just having a terrible retirement.
Well, we are talking with Tim Stearns, CFP, president, founder of TJ Stearns Inc., home of the Protect and Grow written retirement blueprint. Two sides to that, protection and growth. And if you would like to have a written plan, a document detailing your plan for good and bad markets and everything in between, and most importantly, how your money is going to work to provide you with lasting financial confidence into and throughout the transition into retirement and throughout your retirement years, pick up the phone and give them a call, 800-640-2256, 800-640-2256, 800-640-2256. You can also visit online, tjstearns.com, tjstearns.com. Tim, one reason I think that this topic is particularly important, it resonates right now, is because many investors have experienced extraordinary gains over the last decade and a half. And we have seen rapid recovery from previous downturns. Maybe not so much with the Great Recession. That could be our more lasting reminder if we've got long enough memory. But like COVID and the tariff day announcements and the Iranian conflict much more recently, but Russia, Ukraine, all of these things were very impactful with people's emotions, but very short-lived. A longer downturn is not out of the question, and in fact should be something that we are always and constantly prepared for.
Right. I mean, and we are seeing that where it bounces back real quick and then makes people, like we talked about at the beginning of the show, lackadaisical. And we need to be ready for that not to always be the case. How do you prepare for that? Well, the easy answer is to have a plan.
Yeah. Larger balances, Tim, don't eliminate this risk either. I mean, a percent is a percent no matter where it starts and ends.
Yeah, exactly. I mean, 20% on $100,000 is $20,000 on $1 million. That's $200,000. And on $2 million, that's $400,000. That leaves a sting.
Yeah, absolutely. And history reminds us, Tim, that downturns do happen. Again, I listed a few of the more recent ones that were more temporary volatility than true market downturns. But what should we look back to in history kind of as a reference point to say, hey, here's an example of a true economic cycle or a true market downturn or lasting event?
Well, let's go way back, and you can look at the dot-com crash from 2000 through 2002. The market lost 50%. The Great Recession, the market, from peak to trough, lost almost 50%. That's 2008 through 2009. And it, couple that with the fact that housing values fell dramatically as well. Then you had COVID crash, which was 30% in a matter of weeks.
Yeah.
And then lastly, you're looking at inflation and rate shock in 2022. Luckily, that market climbed back pretty quickly. But market declines are not unusual. They're inevitable.
hmm I like your particular phrasing there, the dot com crash, because Tim, I have more commonly heard that as the dot com bubble, right? There's two sides to this. When markets are going extraordinarily well, and then all of a sudden they are not. Does today's kind of AI craze and the big appreciation that we've seen in the market remind you at all of the dot com phase of the bubble or bust?
Oh, it seems very familiar, especially when you have like SpaceX talking about merging with Tesla down the road, and neither company has ever had earnings, a profit rather, I should say. I mean, sounds very familiar to me. Ask Jeeves, Pets.com, all the great ones that were out there. I remember those days, and I feel like a lot of the public does not.
Well, you are correct, though. Market declines are normal. It seems like every generation, maybe every decade, experiences at least one or a couple. But Tim, to the point of our conversation here and the importance of what you put together, that specific written plan, the Protect and Grow written retirement blueprint, why does retirement make downturns in the market even more dangerous?
Well, they hurt more because you're not adding money to it, and you're withdrawing from it. So it magnifies the losses. The timing matters more than the averages at the end of the day. So that's the key.
During our working years, Tim, we've actually taken advantage of downturns, but
Absolutely.
that all switches and reverses in retirement. We call it sequence of returns risk.
Right, which most people don't even know about. And basically, just to put it in layman's terms, if the market is going up when you first retire, that is a great thing. But to your point, it works in reverse. If the markets are going down as you're pulling money out, it's almost like a vortex, and it can really wreak havoc on a retirement.
But but Tim, we should base our financial outcome on planning, not just luck or timing or the particular sequence of returns we retire into.
Right. We have to realize we're not at a blackjack table, and we're not playing a hot hand. Yes, correct.
One large component of market returns, Tim, I think sometimes goes undiscussed, which is confidence, our lifestyle confidence, the ability that we have to travel, to enjoy, to have family experiences, to participate in our hobbies. When the market has a downturn, are these things impacted for those that don't have this kind of plan?
Sure. You start to say, can I afford this trip? Should I spend less? Am I going to run out of money? Do I need to go back to work? All those things that are just going to give anxiety and make you miserable.
Well, Tim, what I appreciate about you on this program, you don't generally present a problem without also discussing a solution. What can help to make a retirement plan more resilient for if and eventually when we do see another market downturn?
Well, it's going to be having, confidence. Preparation is going to beat predictions. Diversification applies to income, not just investments. Resilience is intentional
And
and by having strategies.
what are those strategies specifically, Tim? Are there any? I agree with you wholeheartedly, but are there any strategies that you suggest to your clients or help them enact or put in place that you have found particularly effective, or any strategies that are discussed that maybe you question?
Sure. I mean, there's a couple out there, but the first one I always like to lead with is the bucket approach. Bucket one would be you'd have some cash and short-term reserves. Bucket number two would be bonds and conservative type income assets. And then bucket three, of course, would have growth investments for long-term needs.
Mhm. And this can help to alleviate the potential for market downturns impacting our confidence, Tim?
So the bucket approach is going to reduce panic, in the near future. It addresses sequence risk. It creates spending confidence. But the con there would be it's going to require some maintenance. It can become overly conservative, and the cash may lose value due to inflation.
Tim, some strategists discuss and propose keeping several years of cash. I mean, 2 years, 3 years, even 5 years of cash on the ready. What do you think
Right.
about this strategy for market downturn resilience in retirement?
Well, the pros to that would be liquidity, flexibility, and emotional comfort. But then, of course, the cons are going to be lower returns, inflation risk, and of course, there's going to be opportunity costs there too.
What do you think are kind of reasonable complements or supplements to the hold a bunch of cash approach?
Well, I mean, cash is going to buy you time.
Mhm.
It's going to, time allows you the recovery to the markets. If there's been a swoon, recovery often solves volatility. So, I mean, that's the flip side to that. So, and then there's another strategy also using guaranteed income sources, which is kind of where I head to. That's kind of my approach, using Social Security optimization if you're lucky enough, using a pension if you still have one out there, using income annuities, and then certain fixed income strategies as well.
And Tim, are you finding that that is comparable to the keep several years in cash model, or is there a good, better, best in this bucket or this income or this cash or this annuity guaranteed income scenario? How do you view or rank these, or is it different for each specific individual?
It's for me, I like this one the most, but it's going to be, not one size fits all. I mean, there's pros to that. It's going to give you predictable income, longevity protection. It's going to reduce stress. The cons, of course, is going to be a little bit less liquidity, lower flexibility, but there's potential trade-offs in growth as well.
Flexibility does create options, though, right? And options produce or provide for our confidence.
Exactly. It's going to give you, but it's going to also give you income stability, and that creates confidence for people, and they sleep better at night.
Well, big takeaway here, Tim, is that I think far too many retirees allow the market to determine their confidence. But if we've got an effective plan, like the Protect and Grow Written Retirement Blueprint that you put together for your clients there at TJ Stearns Inc., the day-to-day, month-to-month, or even year-over-year returns of the market don't ultimately determine our outcome and our confidence.
No, they don't, because markets are unpredictable. Planning creates stability. The panic you see is from lack of planning. And you and I have talked about that ad nauseum, but retirement should not depend on specific perfect market outcomes.
Well, unlike my sunburn, where I knew when I was going to be out in the sun and could have easily looked at the weather forecast to give myself a little bit of advance notice. Tim, sometimes market downturns happen unannounced and unplanned and unprepared for. But if we are unprepared, they're going to impact us much more than they should. And that's why you always make this offer, no cost, on a complimentary courtesy service to put together that Protect and Grow written retirement blueprint for listeners and viewers of the program.
And we're happy to do that for people because, I mean, they want to make, if you plan, you'll have confidence and you'll sleep better at night, and you can know that you're going to have a 30+ year retirement, and, make sure it's specifically crafted for you.
Well, the goal is not to eliminate the risk of or the volatility of the market, ladies and gentlemen. It is to build a retirement plan that can withstand it. And if you would like your Protect and Grow written retirement blueprint, pick up the phone and give Tim Stearns, CFP, the team at TJ Stearns Inc. a call. And what I particularly love about the team there at TJ Stearns Inc., they coordinate the planning from the investment standpoint, the income generation, the tax implications, the healthcare, the benefits, the Social Security, the legacy planning standpoint. All of that is looked at. It's not just a access to the market and here are some mutual funds conversation. It is holistic, it is comprehensive, and it is customized, personalized specifically for you. If you would like that kind of planning for your retirement, for your Protect and Grow written retirement blueprint, give a call to TJ Stearns Inc. and Tim Stearns CFP. 800-640-2256, 800-640-2256. Tim, as we enter into the hot months of summer, don't forget the sunscreen, ladies and gentlemen. And of course, as always, don't forget to have a plan in place that will prepare you for some market volatility. Tim, we appreciate your insight in reminding us that those things are important.
Thanks for having me, Peter. And make sure you are wearing your sunscreen.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.